Coming up, inflation rises to 6.8%, what it means for interest rates and why the share market fell to a 2-month low. It is your daily 10-minute business and finance news wrap for this Wednesday, the 31st of May 2023. Later, coal stocks leading the share market down to a 2-month low. But first to the economy, where the inflation indicator rose from 6.3% to 6.8%. For more details on what it says about the economy and the direction of interest rates, Rhayna Bosch spoke with Stephen Wu, an economist at the Commonwealth Bank.
So today's April monthly CPI indicator did tick up in an annual change basis. So we saw the annual rate tick up from 6.3% to 6.8%. But that does largely reflect what we call base effects. So comparison from a year ago, sort of artificially inflating some of those figures. If you look at the month-on-month change, what we saw was consumer prices increased by 0.3% in the month of April on a seasonally adjusted basis. That's a slower pace than in February, which was 0.6%, and in March, which was 0.5%. So we think today's data still does suggest that inflation is continuing to decelerate in the economy.
Now, as you mentioned there were some key factors that played in, petrol for one playing a rather large role. Can you take us through how that kind of drove the figures?
Right, so petrol prices did increase 2.9% in the month of April. And when you factor in a comparison from a year ago, that's actually boosting the annual rate. So a year ago, if you recall, we did see a halving of the fuel excise tax. So that saw petrol prices down about 14% last year in April. So comparisons are being sort of a bit volatile because of this annual change basis. So, for instance, in the month of May, petrol prices at the Bowser are down about 5% in the month. So we should see that sort of detracting from inflation in next month's CPI figures.
Now, when we delve a little bit further into those figures and that breakdown, what else did you identify as contributing to that rise?
Two key categories that surprised us on the upside were rents and also travel. So rent inflation was up by 0.8% in the month. On an annual basis, it's at 6.1%, which is the highest pace since September 2009. So we are seeing an incredibly tight rental market with very low vacancies interacting with very strong housing demand as a result of population growth. So that's been stronger than what we had expected, and we should continue to see rent inflation increase as these sort of demand and supply factors continue to play a role going forward. The other category that we sort of were surprised by was in travel. So domestic travel was up about 6%, and international travel and accommodation was up about 8.6% in the month. So typically, travel prices do increase in April because of Easter and the school holidays. There's just more demand for travel. But we had expected, given cost of living pressures, that there'll be some pullback in travel demand this year in April. However, it looks like we are still seeing quite strong demand for travel, and we did see as well quite a large lift in the month for travel prices.
Now, Stephen, if we look at this kind of broader picture from afar, it doesn't look very good. How do you see inflation moving next month, and do you see any other bumps along the road?
So we still see inflation continuing to decelerate over the rest of this year. So our forecast is that inflation will be below 4% on an annual basis by the end of this year. We still see, goods disinflation occurring, and we don't see, a breakout in, say, services inflation. It might be a little bit bumpy on the way down. So a couple of things might, throw a spanner in the works, so to speak. So, for instance, we know there's going to be an increase in tobacco prices as a result of increase in taxes there. More annual changes in things like healthcare in terms of private health insurance could also throw around the month-on-month figures. But the overall trend, we think, will still be going down. We think the economy is slowing. Households are pulling back on spending. We can see this in the spending data that we have. And so we are comfortable with the view that inflation will continue to fall over the rest of this year.
Now, all of this does kind of spell out some good news for the RBA, who are meeting next Tuesday. What do you foresee happening at that rates meeting?
Our call is for the RBA to be on hold at their June board meeting next week. If you recall, we have had a run of weaker than expected economic data. So the labour market is now loosening until the unemployment rate ticked up from 3.5% to 3.7%. Retail trade has come in softer than expected as well, and wages growth has also been weaker than expected. So we think that in combination should mean the RBA is on hold. One last piece of data that the RBA will get before next Tuesday is going to be the Fair Work Commission's annual wage review. So they're due to hand that decision down this Friday at 10 a.m. So we'll be looking at that quite closely to see what's going to happen to the minimum wage over the year ahead.
And finally, Stephen, we did have the RBA Governor Philip Lowe speaking today at that Senate hearing. What were your key takeaways from that?
A couple of things. One was the governor was quite clear that he considers monetary policy to be in restrictive territory now. So that means it is having a contractionary impact on the economy, and so the economy should be responding accordingly. There's also a mention as well of the increases in housing debt servicing costs. So the RBA does expect, housing debt servicing costs as a share of income to increase to 10% as a share of household disposable income by the end of next year, and that will be its highest share on record. The third point to note as well is that the RBA considers the federal budget that was handed down earlier in May to be broadly neutral. So they don't think it shifts the dial in terms of the interest rate setting. That's something that we had been expecting and have written about as well. And it was good to hear that confirmed as well by the RBA governor.
Rhayna Bosch there speaking with the Economist at the Commonwealth Bank, Stephen Wu.
Yeah, so
now, the inflation data did have an impact on the Australian share market, which did fall today, down 1.6%, 7,091. For more, I spoke with Shaw and Partners Senior Investment Analyst Adam Dawes.
Yeah, so CPI numbers weren't really good. The Australian share market extended losses led by heavy sell-off in mining and energy companies as the inflation data bolstered the case for the RBA to raise rates on June the 6th. The inflation number came in at 6.8%, and that certainly is high. But important to note that significant contributor to that increase was automotive fuel, and other components was housing, food, and that continued to drive inflation higher. But we've got Friday's minimum wage decision coming up, electricity bills set to rise again in July, and rents continuing to skyrocket. This will all put pressure on our market going forward.
As you mentioned, coal miners are leading the market down today. Why?
Well, they led the market. Newcastle coal futures tumbled around 12.1% today to $140 a tonne. Prices have now collapsed more than 60% since trading above $400 in December 2022. Analysts put a retreat in the coal price down to softer demand in China, India and Asia, all sort of seeing those softer demands. And as well as we have PMI numbers coming out from China today, which was certainly softer. That came in around about 48.8. Previously 49.2. So that means their economy is contracting at a rate of pace.
Oil is further weakening below 70 US today. What's behind that?
Yeah, below 70 US a barrel. The physical market or the crude market signaled that supplies were more than adequate to meet the softer demand. And that's the whole bit about it. Crude prices have dropped around 13% from this year amongst China's lackluster appearances, obviously in their performance or their manufacturing index as well. But all eyes will be on OPEC on June the 4th to see what they're going to do, whether they're going to maintain production or in fact reduce it again. So it's going to be interesting to see how that oil does play out.
And finally, where do you see the opportunity for investors at the moment?
So we're recommending clients, and the opportunities where we see going forward is we're recommending clients to stay in the defensive stance in the domestic equity portfolios, but always stick with the quality. Wesfarmers had a really good investor day yesterday and think there's some opportunity there, but also we're seeing upgrades in the travel sector, Qantas, Webjet and Hello World, just to name a few. So there might be some opportunities in that travel sector at the moment also.
That is Adam Dawes there from Shaw and Partners. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.